Hi, welcome to Accountancy Point YouTube channel. Before we delve into working capital management, we need to introduce a few concepts that are crucial for understanding this topic. As you surely know, well begun is half done. So let's start by explaining the term working capital management. It refers to a company's short-term financial decisions and the way they affect current assets and current liabilities. By definition, current assets are expected to convert to cash within a year after appearing on a firm's balance sheet. It's important to note that in the balance sheet, current assets are presented in order of liquidity. What does this mean? As you can imagine, order of liquidity refers to the amount of time it takes for current assets to be converted to cash. A company's balance sheet always begins with the most liquid assets. Therefore, it presents cash first, followed by marketable securities, accounts receivable, and lastly inventory. Along with current asset investments, firms also incur short-term obligations called current liabilities. These are usually due within 12 months. Accounts payable, accrued expenses such as wages and taxes, and notes payable are the three most common types of current liabilities. Alright. Here's a question: what does effective working capital management aim to achieve? One of the goals is to make sure a company has the funds necessary for its day-to-day operating expenses. And the second objective is to ensure that a firm's assets are invested in the most productive way. Achieving these two goals requires a good balance, though on the one hand, insufficient liquidity could lead to severe consequences such as selling off assets and reorganization via bankruptcy proceedings. On the other hand, an excessive cash position may not be the best use of a company's resources. Why? Because cash has an opportunity cost. This is one of the reasons why firms holding extra cash opt to invest in short-term liquid securities, such as U.S. Treasury bills, bank certificates of deposit, and commercial paper. This way, instead of having cash sit idly, companies can earn a return on it. Also, in the case a need for cash emerges, firms can easily liquidate the securities they have invested in. To sum up, an effective working capital management includes three important aspects. Companies need to first maintain adequate cash levels and invest idle cash in short-term marketable securities. Second, convert short-term assets such as accounts receivable and inventory into cash. And lastly, firms have to control effectively outgoing payments to vendors, employees, and other related parties. In our next video, we will examine liquidity management. Stay tuned and thanks for watching.